Welcome to my video. I'll trust you'll find it helpful and informative. Please remember to like and subscribe. Thank you.
Good morning, guys. This morning I'm going to look at a question that I've looked at before. It is question 2 in assignment 1, and it's about inventory valuation. The difference this time is that I'm going to try and do it a little bit differently, firstly, but then secondly, I'm going to compare the two methods of inventory valuation for you. The method that you are asked to do the calculations in this sample paper here is the perpetual weighted average method, but there is, of course, also the first in, first out, the FIFO method. I'm going to have a look at both just so that you can see the difference between the two and understand why you would use the one and not the other. Really, it's a matter of choice. But let's start. So here is the question. So it says the following information is given, and there you have your movements of inventory. You start with a balance of 218, and then through the month you make certain purchases of inventory, and then of course when you have a sale you get rid of some of that inventory. In this case, you always make sure that you have enough inventory on hand, and then they ask you to do the following: to calculate the closing stock, to calculate the cost of sales, to calculate the sales, and to calculate the gross profit. Now, just another thing, just remember, when you know that gross profit is sales minus cost of sales, so, and to calculate the sales is quite easy. You could say, well, it is 349 times 116624 plus 458 times 1195.4 plus 283 times 1224.55. So the sales are obvious. The difference between the two methods and the two things that are going to be different when I compare it is the cost of sales. So therefore, I'm always going to do the sales first and then the cost of sales. Although you will see that the cost of sales is really 80% of what this question is about. So let's have a look at it. So this is the question, and then of course, like I always do when I'm doing it for you in Excel, I just repeated the given information there in that little table there, and what we are required to do, I've put there: calculate the following to 2 decimal places: the closing stock, cost of sales, sales, gross profit, and I have color-coded it for you as I always do. So let's start somewhere. So we know that on the 2nd, we started with 218 units, and that, of course, was given. And now here you will see I have added a number of columns here. I said, before we can calculate the cost of sales, we need to calculate the stock value and the cost price per unit that we are going to use when we do our cost of sales. So in this case, we know that the stock value is 63,560. How do we know that? Well, it is simply 218 units multiplied by the unit price of 291.56, and we get the 56308. Okay, and just so that you know how I got that, every time I gave you the little sum next to the answer. Now, if you want to calculate the cost price per unit, it will still be 219.56. Nothing will change, but the way we would normally do that is we would just do the division, but in this case it is given, so we don't have to worry. So that's how we start with the given information. The only calculation we did there was to get the stock value of 63,560. Then on the 8th, we buy 305 units. Okay, so if we buy 305 units and we had 218, we now have 523, and that was of course simply by adding the two. And now I can calculate the stock value. But now in this case, when I calculate that stock value, it will ask me, how did I get that? Well, just remember that what we had is we had the 63,560, but then we buy an additional 305 units at the new price of 320, and of course we must add those two together, and that is how I get to 161,000, my stock value here. To get to my cost price per unit, then I will have to take my stock value, because this is the weighted average method, and I will take that stock value and I will divide it by the total number of stock items that I have, which in this case is 523, and then I see that my stock value per unit that I am going to use when I calculate my cost of sale at this point in the month is 308.57 rand. Okay, we go on, and we know that on the 10th we make a sale. Okay, and we know that if we had 523 in stock and we sell the 349 given there, then we are left with 174 units. Well, what's the stock value? The stock value will now be what we had before, the 161,379 something, minus the stock value of what we are selling. And now we will take the 349 that we are selling, and we are selling them at this cost price per unit that we calculated in the previous step, the 309, and then we will get a new stock value. But when we make a sale, the cost price per unit will not change. It will stay exactly the same. Okay, so you don't have to worry about that. Then on the 14th, what we do is we purchase another 436 units. We add that to the 174, and we are now sitting with 610 units. We can calculate the stock value again. We know that we had stock to the value of 53,690. Now we are going to add the stock value of the 436 that we bought at almost 350 rand, and our new stock value is 206. We take that stock value of 206, we divide it by the total number of items in stock, the 610, and we get a new average weighted value of our stock of 338.09. Good. And then again, on the 21st, we have a sale. And if we have a sale of 448 units, we are going to subtract that from the 610. We are left with 152 units. Okay. We have to calculate our new stock value. It was what we had minus the value of the stock that we calculated at the price of 339. So it is the 458 units that we sell, and we get to a new stock value of 51,389. My number there will of course not change when we make a sale. Okay, so we're getting there. On the 25th, we make more purchases. What do? We had 152. We buy another 262 to give us a total of 414 units. Well, we need to calculate the new stock value. It is what we had, the 51,389, plus now the 262 units that we are buying at 379. It gives us a new stock value of 150,695 and a couple of cents. We go and we divide that stock value by the total number of stock, the 414 rather, and we get a stock value per unit, or cost price per unit, of 364. Okay, then on the 27th, we make our next sale. What are we selling? Well, we are selling 283. That 283 must be subtracted from what we have on hand. we are left with 131 units of stock. We have to calculate the value of that stock by taking the 150 that we had, subtracting the 283 units that we are now selling, and we multiply it at the stock value per unit that we calculated in the previous step, and we get 47,683 and 76 cents. So once again, when there is a sale, the stock value or the cost price per unit does not change. Okay, and then finally, on the 29th, what we do is we purchase an additional 327 units, and we had 131 in stock, so we add the two together, and we end our month with 458 units. Once again, we calculate our new stock value, what we had on hand, the 47,683, plus now the value of the 327 that we're buying at 408, and we get a new stock value of 181,000. And if we divide that value by the total number of items that we have, the 458, we get a cost price per unit of 395. So if in the next month, on the first day of the month, we are able to make a sale, we will sell those at the cost price of 395, and that is what we are going to use when we calculate our cost of sales. Remember, everything else is simple. It's just the cost of sale that is the difference here. Okay, so what do we know? The first thing we had to do was we had to calculate the closing stock, and there we have the closing stock. Now, you could have just gone to 18 plus 305 minus 349 plus 436 minus 458 plus 262 minus 283 and plus 327, and you would get to the same amount. I just did a step-by-step here for the sake of the cost of sales. Now, when it comes to the sales, that is not a problem. Really, we know when we had a sale, we know what we sold it at per unit and how many we sold. So when we calculate our sales, we will simply multiply those two, and we had another sale on the 21st, so we will do it again, and we had another sale on the 27th, so we will do it again. We can add all our sales together, and then our sales is 130,105.8.61, 1.3 million. Very nice sales that the company achieved. Okay, what about the cost of sales? Well, now when we get to the cost of sales, we will have to say, good, it is still 349 units that we sold, so that's not going to change, but we have to multiply it at that cost of sale that we used when the transaction took place. So on the 10th, the cost price per unit that we used was 308.57. So if we multiply those two, we see that our cost of sale is 107,698, and then we can go and we can calculate the gross profit on that deal simply by taking the sales minus the cost of sales, giving us our gross profits. Okay, so on the 21st, we have our sales, but as far as our cost of sales is concerned, again, it's the 458 units, and this time our sales price that we used here on the 21st was 338.09. So we multiply those and we get 154,000. Once again, we can calculate the gross profit. Then the last sale we made was for 283 units. We're going to multiply that 283 by the cost price that we used when we made that sale, which was 364. We get to a value of 103,000, and we can calculate the gross profit. And now to calculate the total cost of sales and the total gross profit as we are supposed to, we can simply add these columns together. That's our cost of sales. And that is, what was the color I used there? Our gross profit. Okay, and so you have now answered the question, and you have said, if we use the perpetual weighted average method for inventory valuation, then at the end of the month, we see that we had sales to the tune of 1.3 million, cost of sales 365,500, and the gross profit of 935,000. So that was our gross profit for a month. Everything very nicely. And now the question says, okay, but now what happens if we didn't use the perpetual weighted average method, but we use the FIFO method? So let's go and have a look at that. Okay. I kept the top part the same because we are going to use that again. But now when we do our valuation calculations to establish the cost of sales that we are going to use, we're going to have to do it a little bit different. Well, the start is not different. On the 2nd, we had those 218 units that was given. We know that they were valued at 291 each, giving us a total stock value of 63,000, and that is still exactly the same. Okay, what happens then on the 8th? Okay, on the 8th, we still have the 281 units at 219 to a total value of 63,000. That didn't change, but we are also buying an additional 305 units at 320 Rand, so that the stock value for those are 97. But of course, when we add them up, we will get exactly the same values that we had when we were using the perpetual weighted average method in the beginning. It's only once we now have this first sale that things are going to start changing. So on the 10th, we are selling 349. Now, 349 is clearly more than 218. So what are we going to do? The entire 218 that we have valued at 291 per unit, we are going to sell. And then the rest, we are going to sell at the cost price of 320. So what is the rest? Well, the rest is the number that we were selling, the 305, minus the 218, which is 131. That 131, the cost price that we are using is 320. So it adds up to 42,000. And remember, that is a cost of sale. And that is a cost of sale that we are going to use here at the top. And then, of course, if we want to know what the position is at the end of the day, we simply take the 523 minus the 218 minus the 131. And now we are seeing that we are sitting with 174 units. They all were bought at 320. Our total stock value now is 55,805. And because it's only the expensive ones that we have in stock, this stock value here will now be a little more than the stock value was when we did the perpetual weighted average method. Comes the 14th and we make purchases. Okay, so we have the 174 at 320. That's valued at 55,805, but we are buying an additional 436 at almost 350 Rand for a total value of 152. And to calculate our total stock and our total stock value, we add those together. Okay. On the 21st, what is happening? On the 21st, we have a sale. The sale is for 458 units. 458 is clearly more than 174. So all 174 units that we are holding at 320 is going to be sold. Okay. The remainder, which is 284 units, is going to be sold at the cost price of 349 that we calculated there. So we are able to then calculate our stock and our stock value. Now, what you will see at this point in time, and of course, once again, these are our cost of sales numbers that we are going to use up here when we do the totals. Which you will know, the number of stock items cannot change if we use another system, but of course the stock value will be slightly different. Then we get to the next day, which is of course the 25th. 25th, we still have the 152 at 349 for that value that we've calculated, but we are also buying an additional 262 that's costing us a little more. And when we multiply those two, we get 99,000. Once again, we add these two so that we can see what our current number of stock items on hand is, as well as our current stock value. Good. Then on the 27th, we have a sale again. We are selling 283 units. Well, once again, 283 is clearly more than 152. So we're going to sell all 152 units that we still are holding at 149.87. And the remainder we are going to, which is 131, we are going to sell at the stock value of 379. And when we do that, we are able to calculate the new item, number of items that we have on hand, as well as our new stock value. Then the last thing that happens here on the 29th is that we have a purchase again. We already know, like always, what we have on stock, in stock already, but we are now buying an additional 327 at a new price of 408 Rand and a couple of cents. We multiply those, and then if we add the items and we add the stock value, we can see that at the end of the month we have 458 units on hand, just like we had with the previous method, but the stock value is a little more because we have gotten rid of all our older stock. So now, I just forgot to tell you, these are cost of sales figures again. Good. Now, it should not surprise you that the sales will stay exactly the same as it was when we were using the perpetual weighted average methods, but now the cost of sale is going to change. How do we calculate the cost of sale? Well, on the 10th, we had these two amounts that we had to add for the cost of sale. We didn't add them here, but here we are now going to add the two to see that the cost of sales is 105. On the 21st, we're going to add the 55 and the 99. And on the 27th, we are going to add the 53 and the 49, almost 50. And of course, then we can go and we can add those together. And now, like we did previously, we have our sales, we have our cost of sales, and then we can simply go and we can calculate our gross profit. Of course, the gross profit is simply the sales minus the cost of sales. And that is the last column that we are then going to total. Was that a bit too bright? Yeah, let's use that. And then you have done it using the FIFO method. And then we have a look at it here. I'm just going to copy these three numbers. I'm going to copy it. And I'm going to bring it in here so that we can compare it with the perpetual weighted average method. And I am using that numbers, and then we can see, look, if I use the same formatting, the sales is exactly the same, but the cost of sales is slightly less, because every time we used it, we got rid of the old stock every time there's a sale, which means that our gross profit will be a little more, and our stock value will obviously also be a little more. Guys, I hope that helped. You know now how to do this question, whether you get it as a perpetual weighted average, which is the normal way, or if they ask you to use the FIFO method, and you can do that as well. I would say that if your stock moves really quickly, it is good to use the perpetual weighted average method. If your stock moves a little slower, I would suggest that you rather use the FIFO method. Thank you. It was nice. Enjoy your day. Thank you for watching this video to the end. If you found it valuable, please subscribe and like. Thank you.